You can't begin to invest before first going through the financial planning process. When you first begin to even start thinking about investing in the online financial markets, it's very tempting to simply give into one-size-fits-all investment strategies that some guru on the internet claims to be the winner. And while they may have made some money with that strategy on their own, chances are that that strategy is not going to work for you. And while that strategy may have worked in the past, there is no guarantee that it's going to work again in the future. But the most common reason why these one-size-fits-all investment strategies don't work for a lot of people, and most people end up losing their money, is that those strategies are not designed for your unique risk tolerance, for your unique financial situation, and your unique financial goals. This is when financial planning steps in. And guess what? You can actually do it yourself. Personally, I lost $15,000 when I first started trading on Wall Street. And even though I was literally reporting on the financial markets on the floor of the New York Stock Exchange on Wall Street, and I was taking advice from arguably some of the best traders out there, but their strategy didn't work for me. For one, because they were trading gazillion-dollar accounts for other people's money while I was basically trading my life savings in a tiny $15,000 account. Later, when I discovered the way to create my own investment strategy that is suitable for me and my level of risk tolerance, I was able to actually restart again with a tiny $500 account, and I was able to grow that to $50,000 in the span of 3 years. So in this episode of the Invest Diva movement, I'm going to show you the 8 most important financial planning steps that you need to take before you begin your investing journey. And step number 2 is literally the most important step that almost all investors and traders forget about. We're going to cue in the intro and dive into the 8 financial planning steps before you start investing. And while we do that, head over to the comment section and tell me if your parents did their own financial planning. I'm really curious to know because in most families, even talking about money is taboo. We're now going to cue in the intro and let's go. Hey guys, I'm Kenna Danielle, 3-time author and the founder of the Invest Diva movement, the march to jump on if you want to take control of your financial future and to make your money work for you. Now let's dive right into the 8 steps of a financial planning process before you begin to invest. Step 1 is fairly easy. You need to set financial goals so that you know where you're going. You first have to understand where exactly you are right now and where we want to go, right? Let me ask you a question. Would you take a long road trip without Google Maps or Waze or map of some sort? Would a pilot fly a plane without reviewing the weather forecast and planning the route? Would a construction company build out a house without a blueprint or planning? Would a teacher teach a course without a curriculum that is specific to the student's needs and level of expertise? These are just a few examples, but don't you agree that in each of these cases, if you don't have a plan, you've got a plan to fail, right? And there is this massive common myth that I'd like to address, and that is that many financial planners have us believe that financial planning is only for the very wealthy people. The reason they make us believe that is that it wouldn't make sense for them to manage your $5,000 portfolio. They want to make a living out of the commissions that they can charge you. So that's why they want to go after people who have millions of dollars. But the matter of the fact is that financial planning is not just for the very wealthy. It's actually the other way around. There is so much value in starting a plan early on for all parts of your journey, especially the ones that will catch you off guard and will cause you a ton of stress and confusion, like weddings, funerals, divorce, retirement, vacations, you name it. They all need planning in advance. So I'll be honest with you, I'm not the best when it comes to planning for small things, and I kind of take things and I work through them. But I have trained myself to at least plan for the major events that have come to our rescue as a family time and time again. Now I have a question for you. What is your biggest 5-year financial goal? Head over to the comment section and let me know. Step 2 is the most important step that you must take before investing in anything, ever, and that is calculating your risk tolerance. This is what will give you the ability to invest in assets that match the amount of risk that you can take. If you calculate your risk tolerance prior to creating your investment strategy, you won't panic all the time and wonder which direction the market is going. You'll have a feeling of safety because you know that the strategy that you've developed can tolerate the risks that you have set up for it. There are two components to risk tolerance. One is your willingness to take a risk, and two is your ability to take a risk. So how do you calculate this? This is where things get fun. You need to spell out your investment goals, your time horizon, and for each goal, your need for liquidity, and your tax situation, among some other metrics. You do need a calculator, or you can just simply reach out for that thing in your pocket, your cell phone, and calculate some of the main ratios that you can see here. And that includes your emergency fund, current liquidity, basic housing, debt, and net worth ratio. To help you figure this out, I'm giving away my risk management toolkit for free if you register your seat and attend my upcoming masterclass by going to learn.investdiva.com/yes. I'm also adding the link to this in the description area of this video so you can open it up in a new tab, save your spot for the next available session, and then go watch it after this video is over. Your risk tolerance and portfolio structure also depends on your life cycle. So for example, between ages 20 to 45, you're probably more growth-oriented, can accept more risk because of long-term horizon. Between ages 45 to 60, you're conservation and protection-oriented. You're concerned about protecting what you've accumulated, and you probably are seeking less risk. After 60, you're probably thinking about your retirement, concerned about generating income, protecting what you have already, and maybe even gifting to your grandchildren. That is called generational wealth. Now, I'd love to hear from you. What stage of your life cycle are you in right now? Head over to the comment section and let me know. All right, now let's say that you get in my masterclass, get my risk management toolkit, and you realize that you don't like your risk tolerance. What are you gonna do? Well, you can either cry about it, or you could get started with step number 3, which is budgeting and evaluating your spending and saving behavior. The budgeting process includes establishing goals, checking your income, checking your expenses, and finding out if you're net cash flow positive or negative. And then you've got to monitor it over time. In Invest Diva's Make Your Money Work For You Power Course, we have the system that helps you calculate your cash flow very easily and almost automatically without having to do any math, so that you can go ahead and increase the amount of cash that you can invest so that you have more money to get it to work for you, right? I have another question for you. Are you currently budgeting? Head over to the comment section and let me know. Step number 4 is creating a written investment policy statement with the risk tolerance derived from the questionnaire that you're gonna get once you attend the Make Your Money Work For You masterclass, which will eventually help you build your own investment strategy. This helps you create an investment policy to ensure realistic return of goals consistent with the acceptable risk and enforce discipline in the investment process. So here are the simple steps you need to take when you're writing your investment policy statement. You've got to document your financial goals as detailed as possible. Then you need to document your risk tolerance that you're going to calculate using my risk management toolkit. Then you got to document your current investments if you have any. Then write down your target asset allocation based on your risk tolerance and financial goals. Having these actually written down and documented might sound a little bit unnecessary, because you might say, well, I just have them right in my head, or I've just put them here and there as in my notes, like all scattered over the place. But trust me, writing them down in one policy statement that you can just reference to anytime that you need and have them all in one place is not only going to put you in the right mindset about money, but will also guide you with appropriate investment choices that will serve you as a benchmark to measure your performance and will prevent you from panicking every time the market goes up and down, and to help you manage your emotions, because you basically can just pull out your big picture strategy in the policy statement out of your sleeve and let the day-to-day market hype and FOMO go away. It's a lot less stressful this way, trust me. Once you have all these 4 steps down, it's now time to select the type of assets that best match your investment policy statement. Depending on your risk tolerance and financial goals, you can create a diversified portfolio, including Different assets and securities such as stocks, cryptocurrencies, futures, ETFs, fixed income, options, real estate, and even Forex. Again, depending on your risk tolerance, you might find out that your portfolio can be exposed to a number of different types of assets. So the goal in this step is to figure out the right asset mix for you. Then, of course, within every category, we can again go one level deeper to see which categories within that category is suitable for you. For example, even with stocks, there are actually 9 different types of stocks that you can select from. I previously made a video about 9 different types of stocks that you can choose from on YouTube. So make sure that you check it out by clicking here or here. I will also add a link to it in the description area of this video. So for example, when I was younger and I was single and I had more time in my hand, and I had more willingness to take a risk, I used to trade Forex. But now that I've become a mom, I no longer trade Forex, and I focus more on stocks and ETFs and cryptocurrency in a medium to long time frame. So that's why we want to go back to our investment policy statement every once in a while, and when major life event happens, and update it so that it suits our current financial situation and our current risk tolerance. And the percentage that you allocate to each of these investment assets in your portfolio depends on your risk tolerance, financial goals, and economic cycle, and your life phase. By compounding these types of assets in your portfolio, you can basically put your money into work and reach your short-term, medium-term, and long-term goals. Now that you have an idea about what type of assets you want to invest in, it is time to examine the external environment and the economic and the geopolitical events that may impact your asset class. This is step number 6, and it's where my signature Invest Diva Diamond Analysis, or the IDDA, comes in, and that analyzes every asset from 5 different points: fundamentals, technicals, market sentiment, capital, which is basically your personal investment policy statement, and the overall how it fits within your portfolio. So examining the external environment is IDDA's point 1, or fundamental analysis. Step number 7 is developing an investment strategy by incorporating all the previous steps, but this time you'll be determining what price you should buy, what price you should sell to take a profit, and how long you should hold your investment. These are defined in IDDA's technical and sentimental points. Now, if you've been curious about investing or trading for a while, and you probably have come across trading gurus who sell trading signals and promise that they'll make you a millionaire. The problem with those signals, even if those gurus are actually legit and really successful with their own portfolio, is that their signals are one size fits all. Your investment strategy cannot and will never be the same as the next person, because you are unique in your unique stage of life that is different than the rest of the people. And your ability and your willingness to take a risk is different than others. And of course, your goals and personal preferences are different. At the beginning of this video, I talked about how I lost $15,000 when I was reporting at the New York Stock Exchange. So what happened is that I was actually surrounded by all of these best traders and investors, and naturally I was watching what they were doing and making my choices based on what other people were doing and what they were telling me to do. So I went all in with my savings of $15,000 at the time, and I was excited to start growing that account, but that didn't get me too far. I kept following what everybody else was telling me to do and to the market noise, and what happened? I lost the whole $15,000. My entire savings. And I was so upset and disappointed in myself. I mean, how could I lose all of my money when I was just listening to what all these successful people were doing, who were making millions? So the problem was that I acted on almost every news, buying and selling a ton of things without having an actual plan. And my investment account was being pulled over in so many different directions that was just a mess and had nothing to do with my financial destination. And the result was losing a big fat $15,000 account. And that's why once you develop a financial plan, and you only have to do it once, then you've got to monitor it once or twice a year, or depending on your time frame, or if something major happens in your life, for example, if you get married or have a child or lose your job or buy a house or receive an inheritance, then you can sit back and relax and let your strategy do the job for you. Can you imagine your money making you more money on its own while you sleep? That is the definition of wealth, and is a reason why I consider myself wealthy, because every time we take a vacation, for example, my money is still working for me in the background, and sometimes even paying for the whole vacation while we are away. In this picture, my husband and I are taking vacation in Bora Bora. So you might have already guessed step number 8, but that is monitoring. And here's what I don't mean by monitoring. Sticking to your screen all day and following the market's ups and downs, that is not monitoring your portfolio. And that will actually bring out the worst emotions out of you that will lead you to losing sight of your investment policy statement and increase the chances of making a stupid decision and losing all of your money. Personally, I monitor my 4 portfolios once a week on Tuesdays at 10 a.m. New York time. And that also includes my husband's and my dad's portfolios. And that's actually when I also go live with our premium investing group, or the PIG members. And now there's a funny story about this. We created the premium investing group like years ago, and it wasn't until last year that I realized it stands for PIG. So now the group, our premium investors, call themselves pigs, which makes me laugh. But following these steps and not sticking to your screen all day when investing is the definition of making your money work for you so that your money can grow and turn into more while you sleep. And yes, that is my daughter taking over our bed while my money is working for me, but I'm totally supportive of that. All right, now if you want to learn all the nitty-gritty and the 3 secrets I'm able to make my money work for me, go ahead and register your seat for my free masterclass so that not only you get that free risk management toolkit, but you also are going to learn how I do this without taking too much risk and how I do this without even being a math whiz, and why being a math whiz can actually cost you when it comes to investing. So open up a new tab, type in learn.investdiva.com/yes, or simply click on the link in the description area, and I'll see you in the masterclass chat box. Thank you so much for tuning in, and remember, the only path to true wealth is by making your money work for you.